Sir, and I will say, I could probably listen to Tripathi, sir, for another half an hour or an hour. It was fascinating, even though he was talking at warp speed. Um, I think what I want to talk about first, and I'll go to your issue of alternative financing and your issue of sustainability, want to talk about the fact that the Indian housing ecosystem, supply side, the production of homes and urbanization, and demand side, the creation of financial products and the creation of liquidity in secondary market vehicles. The Indian housing housing ecosystem is evolving unbelievably fast. And as Mr. Goel, sir, talked about in the context of COVID, and Mr. Tripathi as well, COVID has been a disruption that in certain ways is also accelerating Indian housing finance innovation. I will say that the response of the RBI to COVID as it related to housing and housing assets, Tripathi sir mentioned the moratorium, was the most progressive, decisive, long-thinking, and effective policy response that I've seen anywhere. It was a dramatic move and it worked. And when Tripathi was talking about the low NPL rates, and there's a question in the question and answer I want to pull out because it highlights something about housing. Letting go of an asset funded through life savings can be soul crushing. However, you need to be prepared for this possibility in case of a slowdown induced job loss or business failure. Tripathi sir talked about the fact that 95% of the borrowers that you're seeking to help are in the economically weaker or low income group segments. Those folks have less ability to withstand macroeconomic shocks than richer folks do. They cannot withstand variable payment rates on their loans. They cannot withstand a 60-day disruption in their income. Their savings levels are lower. These are global phenomena. And we have some continuing experience with India. We invested at the founding of a small, very progressive, very capable HFC called Sevagri Rin, otherwise known as Sitara, and we've watched it grow. That's right at the level between formal and informal. As you go down pyramid, it is very, very, very important for you to bear in mind that the household can take fewer risks than a higher income household can take. And you have to design the financial products to insulate the customer from those risks. And I'll come back to that in a second. Then you go to the co-lending issue, as you discussed, and the segmentation of your demand side value chain. So you have the originator, you have the original underwriter, you have the closing, then you have funding, and then later you have liability management. All of Mr. Goel's discussion about asset liability management relates to the fact that you are offering financial instruments to customers that will run 5 and 10 and 15 and 20 years, a very long time horizon. And you really have to set those with some kind of fixed payment. Otherwise, you're asking for trouble because the customers can't stand it. But right now, your non-insured, non-governmentally backed liability side, your liquidity side, is shorter. Now, the United States solved that problem 75, 80 years ago by the creation of something called the Federal Housing Administration, and later resolved that problem with Fannie Mae and Freddie Mac, which were government-sponsored enterprises designed to create tenure-matched liquidity to align with the tenor of the home loans. So that's where the 30-year fixed-rate mortgage came from in the United States. The government backed it. But when the government does that, the government puts itself at sovereign risk. And you have distinguished between depository institutions in terms of regulation and banks, and non-depository institutions in terms of HFCs. With Fannie Mae and Freddie Mac, and to another extent FHA, the federal government put itself in the business of backstopping what you would call HFCs, non-depository lending institutions. That's an inevitable thing to have happen. And we can look at the RBI's actions during COVID as a first intimation that when the problem really arises, the government will be there, because that's effectively what the government did. Didn't do it perfectly because it didn't do a moratorium on the lender's liquidity, but it did it very effectively at the household level. And the reason I start with that, Gupta sir, is because when you are thinking about financing this whole inventory, housing finance is a capital hog. It eats all the money you can possibly give it. And there is a temptation to think of that capital hog as being debt driven. It's very tempting because you want to do net interest margin, you want to match spreads, you want to match tenor. But really, the capital that you need is equity, because the equity takes all of these risks that do not neatly lend themselves to securitization or asset liability match or interest rate match. And so you want to build up equity. There was a reference to non-convertible debentures. There was a reference to convertible preference shares. Financial products that investment bankers like me make that are classified as equity for bank regulation or HFC regulation purposes, but look like debt in the sense that they may have priority or a mezzanine or similar position, those become a magic new form of capital that intermediates between the pure common preferred equity that you get out there in IPO land and the classic forms of liquidity that you get from banks and folks like that. So the first place I would start on the issue of alternative financing is you really want to think about those intermediate products, and you really want to develop both a longer term yield curve and what I call a longer term risk curve. What are the spread differentials in effective IRR between the AAA rated stuff and the bank debt stuff, and then these forms of capital and portfolio expansion? I would even respectfully suggest that the co-lending exercises that you're seeing are essentially a form of pre-securitization, because you're doing a big little on balance sheet. A big balance sheet stands behind or takes a portion of the liquidity for a little balance sheet. So that's, I guess the first thing I would say. The second thing I would say, you asked about emerging trends in building materials and sustainability and green. Biggest thing about green, first of all, a pucca house is greener than a kacha house. So you want to think of green not just in the building materials, but simply in the basic mechanics of life. And related to that, let me go back to my customer. My customer would like to be green, but he or she can't afford to be green. They're payment constrained. So in the US and in Europe, for all this talk about green finance, all of it emerged, almost all of it emerged initially off of subsidy, grants, tax credits, and other kinds of stimulus incentives for the suppliers to reduce the cost to customer of bringing those building materials in. Because you have two barriers, Gupta sir, in trying to get people to adopt sustainability. One, they will not pay more for it. They like it, but they will not pay more for it, because paying more for green means you pay less for your children's education and your kids' food and everything else. So that's one. And then the second is there is this nagging belief in lower income folks that if you sell me something cheaper, it's not as good. So if you're going to give me a green technology, let me see it work first. And the way to do that is to make it cheap to me. And then my neighbor has a solar panel or a hot water tank on the roof or a water filtration unit or any of those things. And then I want one because my neighbor has one who has a better quality of life.